Chapter 3, The Adjusting Process, Financial Accounting, Slide 3 of 3. We're going to be talking further in our final section about adjusting journal entries, and I found this. Looks like it's British because of the way they spell recognized, but I love this picture. Accrual basis versus cash basis, and please note at the bottom, it very clearly tells you that the cash basis is not GAAP, and it's not supposed to be used for a professional set of financial statements. Why? I mean, it's just a set of rules. It's sort of like the fact that if you play baseball, 3 strikes and you're out. And if you go to a kid's game where they have their own little set of rules, then it just doesn't stay consistent. When companies understand that according to GAAP there's a consistency, then they know that the accrual basis has been used and revenues are recognized when they're earned and expenses are recognized when they're incurred, which means whenever they are spent to help the company. So let's talk about one of the trickiest ones, depreciation expense. First, this is a question asked on many exams and missed by many students, and that is, depreciation has nothing to do with value. Depreciation relates to the fact that, yes, the company assets aren't worth as much, but we're recording this expense to give ourselves just an allocation of the asset's cost on an even and consistent basis. So stop and think about it. If depreciation wasn't recorded, then if a company bought a $5,000 copy machine, that $5,000 would be an expense immediately. However, that $5,000 copy machine may be working and last for 5 years. And if we were to evenly allocate its cost over the 5 years, you could say, okay, I paid $5,000 up front, and that copy machine only cost me about $1,000 a year because I used it for 5 years, and after that I got rid of it. So we're going to be using some of these concepts to talk about depreciation expense, and we will have a full asset on this concept in the future. Okay, so the adjusting entry to record depreciation is very similar to supplies. We have an asset that we have recorded, and we have to show that that asset is being used. Except supplies is a little more consistent to an actual dollar value, and depreciation expense is only an estimate. So we're going to be using an account called accumulated depreciation. And you probably saw that in slide number 2 of this chapter. And you went, what's this accumulated depreciation recorded in the asset section of the chart of accounts? It's a contra asset. Contra means against. So this is an asset account with a credit balance. Yep, here comes the confusing part. Depreciation expense is an asset account with a credit balance. So what we're going to find is that a lot of accounts have an accumulated depreciation account. We have land that actually doesn't have accumulated depreciation because land is considered to be there and permanent. Now there are exceptions, but that's beyond the scope of this class. But we find that buildings and store equipment, office equipment, computers, trucks, etc., these types of assets will all have an accumulated depreciation account too. Okay, so let's take an example. Net Solutions has an office equipment, a piece of office equipment that they have recorded the $50 in depreciation during December. They need to record this. So the first question students usually say is, where'd that come from? Well, fortunately, in Chapter 3, you don't have to worry about how the calculation was made. In a future chapter, we will discuss how depreciation expense is calculated. Just know that this is an estimate. And this is what the adjusting journal entry will look like. So for this chapter, you're kind of fortunate. All you have to do is memorize what this adjusting journal entry looks like. You debit depreciation expense, and you credit accumulated depreciation. Now I'm going to try to write an acronym up here. As I have said before in making these videos, I'm not really good. Oops, sorry, I'm not really good with using the pen part, but let's see if I can do this. This comes from many years of teaching. A D, an E. Yep, not so easy to draw with, but that's okay. Okay, this is an acronym, and students have memorized this acronym. I want you to look at the adjusting journal entry, and I want you to look at the acronyms. Depreciation expense, DE, and then the credit is to accumulated depreciation, AD. So maybe that helps. It's one of those adjusting journal entries that students just frequently have to memorize. They just say it's too complicated to start with. Okay, so let's move forward, and here we have it. We will see how this accumulated depreciation expense is recorded. So we have our asset up here. Notice we don't touch it. I'll come back to that in a minute. What we do is increase depreciation expense, and we increase accumulated depreciation. So we don't touch or record anything against office equipment because of the concept of historical cost. And that means that assets, historic costs, are left on the financial statements. Plus, that office equipment didn't go down $50 in value. It's just an estimate. So my favorite definition is that depreciation is an allocation of an asset's cost over its estimated useful life. You might want to pause and write that down. Depreciation is recorded as an allocation of an asset's cost. Okay, want to bring this up too, and that is that an asset has a book value. So if you take what it cost and you subtract out the accumulated depreciation of the asset, then you'll be able to find out what the book value is. And this book value isn't really how much money you're going to get if you turned around and tried to sell it, but instead it's just the value on the books, which sounds kind of strange, but it is the book value. So a truck costing $50,000 with $20,000 in accumulated depreciation. Okay, so that's our hardest one. Accumulated depreciation trips up many students. If you just remember the DEAD, it will give you a little bit of a help to remember what that journal entry is. And then when we learn how to do the calculations in a future chapter, you'll at least know what journal entry to record. So these are our adjusting entries for Net Solutions. And remember, this is what a journal looks like. And this is the way that they recorded originally. And we have up here at the top that this is the journal. It's page 5. We show the headings of a description and the reference, the debit, the credit, and the date. So all of the entries that we've made related to supplies, insurance, rent, accrued fees or accounts receivable, accrued wages, and depreciation expense. These are our adjustments, our AJEs. They're recorded before we prepare financial statements. And once once the general ledger or the accounts have been adjusted, we can go ahead. Let's look at what this would look like if we were to take the ledgers. Remember, the ledgers are like the T accounts. Look at all the transactions in this company. And if someone wanted to know where to find them, they would go to the posting reference and look all the way down through here. There's the page of the journal. And the dates are all listed over here. This is the account title cash. It always has lots of transactions. Here's our accounts receivable. Notice adjusting entries there that have been posted. Remember posting? Here's supplies. Notice the adjusting entries that have been posted. And each of the accounts, I don't want to read each one of these, but I'll go through with a highlighter. Land had no adjustments. Office equipment, however, has this accumulated depreciation, and I should stop here and say, what is the book value of the office equipment for Net Solutions as of December 31st? And the answer is $1,750. You just subtract. If you you don't remember what book value is, why don't you reverse the video and see what you got. Accounts payable, wages payable, and we have even more in here. We have unearned rent. And then notice these haven't been touched. A lot of these haven't had any journal adjusting entries. In fact, common stock hasn't been touched at all. It's still there from the very first. It usually isn't touched at all until they decide, if they decide to issue more stock. Revenue has an adjustment, and all of the adjustments are listed in yellow. Last page of adjusting entries, posted to the ledgers. Again, these are coming from the journal entries, the adjusting journal entries. Okay, and finally, we get to the adjusted trial balance of net solutions. And look at this, it all balances. All of the accounts, the debits and the credits, all equal to $43,400. We have adjusted. We've got some new accounts that we've learned about. We've increased our revenue because we got some rent revenue and some receivables. We have depreciation expense recorded down here. And hopefully some of you are stopping and taking a full picture and thinking, this is bookkeeping. This is what it looks like. From this adjusted trial balance, I can prepare an income statement, a balance sheet, a statement of retained earnings, and I can have financial statements to give to the users. Maybe it's my creditors, maybe it's the owners, managers, but this is the accounting process, and this is what bookkeeping is essentially about. I really hope this helps, and we'll be moving forward and advancing with each piece of the items that we've learned. Chapter 3's homework will have a really good learning curve for you, and I say good because I think it's always good to be learning. Be patient. Now, I want to talk about the adjusted trial balance one more time, and that's the fact that it not only verifies the equality, but it's done before financial statements are prepared, and as I've said here, we are in business. So a question I've asked that has been missed by students, and so this will be a good tip for a future exam. Why does a company prepare adjusting journal entries? And when do they prepare adjusting journal entries? And the answer is, adjusting journal entries are prepared to update the accounts for accruals and deferrals for items that need to be recorded because we're on an accrual basis, and they are also done so that we can ensure that our debits and credits equal, and to make sure that they're ready for financial statement preparation for users. So, good luck with your Chapter 3 homework. Look forward to Chapter 4.